Hi, today we are going to learn on Chapter 5, Company Taxation. Okay, before we start, I introduce you with scope of charge under Section 3 of the Income Tax Act, which says that income tax shall be charged for each year of assessment upon the income of any person accruing in or derived from Malaysia or received in Malaysia from outside of Malaysia. This means that for company, if the company accrue any income in Malaysia or derive any income from Malaysia or receive in Malaysia from outside of Malaysia, the income will be subject to Malaysian taxation. Okay, next let's look into the resident status of a company. Unlike the individual person, resident status of a company is determined by looking at the management and control of its business, whether it's exercised in Malaysia or not. So if the management and control is exercised in Malaysia, therefore we can say that the company is resident in Malaysia. However, if not, then the company is not resident. So what are the management of control? This refers to the meeting of the board of directors. If it is held in Malaysia, means that it is exercised in Malaysia. Therefore, the resident status of a company does not refer to a location of its business operation. Whether the location of business in Malaysia, it just indication of the permanent establishment exists in Malaysia, not the resident status. Okay, next, what you need to understand first is on the difference between accounting statements, financial accounting statements, as well as the income tax return. Okay, so actually the process starts with the preparations of the financial statements according to the Malaysian financial reporting standards, which comprise of income statements, balance sheet, equity statement, and so on. Okay, and next, the statements need to be audited by the external auditors, and finally only the company will prepare taxation for paying taxation using the form C. Okay, so under the self-assessment system, the company need to compute their own taxability in the form C for company. And if you remember, form B for individual with business and form BE for individual without business. Okay. So for company, we're using form C. And then after they compute themselves the taxability, they need to pay to the IRB within 7 months after closing the accounting period. But actually, company has already estimated their income at the beginning of the year, where they need to pay to the IRB using a specified form. And at the end of the accounting period, actually they need to compare whatever they have paid and whatever they have calculated. So they need to pay the difference, or they can claim from IRB if what they have paid is more than what they have calculated. Okay, next, the difference between accounting and taxation incomes for companies tax. As you know, accounting will be based on standards, approved accounting standards, and income also will be based on accrual basis. And then we compute the income by taking the revenue less the expenses, and the income will be displayed or disclosed in financial statement as required by the standards. Okay. However, income taxation will be based on the Income Tax Act 1967, and normally we prepare the taxation based on cash basis, which means that if you receive the income, regardless whether it is for the future years, it will be taxed in this year. Okay, and then taxable income less deductible expenses. That is how we find the chargeable income, or first the adjusted income, and then we will deduct other reliefs or rebates to arrive at final taxability. And we will disclose in the income tax return form, ITRF. That is the final form that the taxpayer need to submit to the IRB. Okay, our aim in this chapter is actually for you all to translate from financial profit, which is before tax, to the business adjusted income, which is will be based to calculate the tax liability. Okay, so this is the one method, okay, where we take the profit before tax and then we translate into business adjusted income in taxation. Okay, so please remember, first step now is to calculate as business adjusted income under section 4 small a. Okay, after we have translated this, then only we will add the business adjusted income, not add, adjust it with the capital allowances to get the statutory income, and then we add all the statutory income from other sections for B, C, D, E, F, if any, to get the aggregate income, and then we minus whatever allowable expenses or incentives given to arrive at chargeable income, and then we apply the tax rate, then only we will get the tax liability to be paid by the company. Okay, so another way to calculate the business adjusted income is according to tax, you can add all the gross income and then you minus all the allowable expenses or double deductions that we going to learn later to get at the adjusted income of the business. And then we minus all the, from the adjusted income, you just follow back this step, okay? Minus all the capital allowances to get the statutory income and follow until the taxability. So there are two methods in finding the business adjusted income. Either you translate like this, or you just recalculate from gross income of the business. Okay. All right. So in order to translate the profit from the accounting to tax income, you need to understand a few what we should say, a few principles in taxation. Okay, so whatever taxable is only revenue in nature, meaning that the the income should be revenue in nature, the expenses also should be revenue in nature, then only we can calculate the chargeable income under the income tax. Okay, so income is revenue in nature. Therefore, you need to identify between revenue and capital. Okay, so that whatever capital in nature, you should exclude from your income to be calculate the income tax. Okay, so if the profit contain, let's say, income from disposal of fixed asset, so that is not revenue, it is capital. Therefore, we need to minus that gain from our income. Okay, that is why you need to differentiate these two. Okay, so capital receipt, how to determine? Normally it is non-recurrent, it one time only. Let's say you want to dispose a car. So if you are a lecturer like me, let's say myself, if I want to dispose my car, so I just dispose, probably I want to change a new car, so it is non-recurrent, tak berlaku hari-hari. Okay, probably after 5 years later, then only I will get a new car again, something like that. Okay, and if for a company, the capital receipt should appear in balance sheet for that item. So item that you are selling is appearing in the balance sheet, so that is the company's asset, and it should be a long-term effect. Okay, because of the cost is higher, so it should have a long-term effect, like probably the long-term loan, something like that. Okay, example, additional capital assets that the company purchased, sales of fixed assets, loans borrowed from bank, financial institution for a longer period. Okay, whereas revenue receipt, it is recurring. Let's say if the person is a car dealer or car seller, so it sells cars every day, for example, so it's recurring. The person receive income from selling cars, It's not like my previous example where I just sell the car probably after 5 years or after 10 years, something like that. So this one, revenue receipt should be recurring. And then if for company, it should appear in income statement as sales, for example. Okay. And it is short-term effect. When you sell, you will get the income in short-term effect. It's not like when you sell, people pay you a little bit in a year. So that one is long-term effect. Example, sales of any kind of inventory, income from services rendered, discount received from the suppliers, sale of scrap, interest received, rent received. So these are revenue in nature. Okay. So these are what we can include in the income. Example, stock in trade, services rendered, what that I have mentioned just now. Income from the use of any property. So it's like rental lah, but sometimes it can be leasing. So this is income from the use of any property. And then insurance, okay, insurance reimbursements, this one from contract indemnity, where you make a contract with other people, then the other people breach the contract, then they should pay something. This one also considered as income for the company. Compensation for loss of income, probably we take insurance. If we take insurance for that key person, so if that what happened to key person, the key person cannot work, then we can get this loss of income. So that one also include in the income. Whatever insurance related to income is considered income. So recovered bad debts, bad debt is not allowed. That is the provision. However, if let's say we have specific bad debt, we know that company A cannot pay us, so it's like we write off that debt. It is allowable. We expense in the income tax. We deduct from the chargeable income. However, suddenly that company come to us and pay the bad debts that we have write off. So we had written off the bad debts previously. So when the company pay, it is called recovered bad debts, which should be included also in the income for the calculation of chargeable income. Okay, specific provision for bad debts no longer required. So probably last year you provide the specific provision, but now you no longer, because probably the company already, you can see that the company is doing business and can able to pay to us. And then recovered expenditure, such as mining expenditure. So later when you learn mining expenditure, probably in the specialized tax, you can learn on this recovered expenditure. So whatever recovered here is also included as income. And next is tax refund, okay, for payroll and also turnover tax. Okay, whatever tax refund also can be included as income, because tax is paid from our income as well previously. So when it is refunded, it should be included back in the income calculation. Withdrawal of stocks. This one is different from financial accounting, where normally financial accounting will record the withdrawals of stock as withdrawals, right? You debit withdrawals and then you credit the stock, right? But in taxation, withdrawal should be treated like sales. So withdrawal should be also included in the income calculation at the market value. You cannot calculate withdrawal at cost. Next, payment received for future services. Okay, since taxation use cash basis, therefore, if payment received for future services also will be considered as income in that year. Okay, in that basis year. However, income exclude, like we said just now, capital receipts. Okay, example here is not only capital receipts but also other things such as income from other section. Okay, because now our aim, actually they are income, but we exclude from section 4A here. We exclude this type of income from section 4A actually. Okay, which are investment income like rental, dividend and interest. We exclude from 4A, but we will add again under section 4 C or D as it should be. Okay, so this one is what you should exclude: gains from disposal of fixed assets and long-term investment disposal, because this item is not revenue in nature. Okay, next, just now we learned about incomes, now we learn about expenses. As I said, it should also be in revenue in nature. Expenses cannot be capital in nature. So example, business expenses, which is considered as revenue in nature, should be related to the business process. Let's say you pay salary to your staff, so it is related to the business expenses, business process. Okay, working expenses, or example, working capital. Okay, you need working capital to purchase your stock whatsoever, so it is business expenses, which is revenue in nature. And the expenses should be recurring, similar to the revenue receipt. It should be recurring. Okay, like paying salary, every month you should pay the salary. If the place of business you pay rental, so the rental expenses should be recurring. Okay, however, let's say before the rental you need to pay like a deposit or advance payment only one time, so probably that one is fall under the other category, which is capital expenses, which can comprise of initial expenditure. Okay, initial expenditure like first time expense. Example, when you learn rental income in tax 1, if you make an advertisement for first time searching for the people to rent your house, it is not allowed as it is initial expenditure. However, when you do the second time advertisement, it is allowed, right? So same in business or in company taxation. For example, you want to have a license, so first time pay the license, probably it is not allowable because it's initial expenditure. However, when you renew the license, so the cost is allowable as it become business expenses, which is considered as revenue in nature. Okay, so capital expenses is connected to the business structure. Okay, the main structure, which is probably we can consider long term, something like that. And the expenses probably related to assets. You purchase the assets, you renovate the asset, which is we can capitalize, and then we can apply the capital allowance on that expenses. So it is capital in nature. And then we purchase assets, of course, and then once and for all expenditure, only one time. Okay, let's say you want to register something, you can register only one time, and then you don't have to re-register every year. Like credit card, probably we have to pay registration fee and annual fee. So registration fee, it is capital expenses, but annual fee, where it is recurring, it is under business expenses, which is revenue in nature. Okay, so these are examples of expenses. So expenses actually we can classify of under section 33(1), which is allowable, and then section 34, specific allowable, means that these expenditure are specifically allowed by the section 34, although it is capital expenditure. Okay, capital expenditure, as I explained just now, is not allowed to deduct, but certain expenditure specifically allowed by the Act under section 34, such as capital expenditure related to mining industry, like replanting expenditure. Okay, nanti you belajar lah dalam specialize kan. When you want to plant something, so first time expenditure for planting, it is capital not allowed, but replanting expenditure is specifically allowed under section 34. And then equipment for disabled person, so the equipment is actually capital assets, but it is specifically allowed under section 34. Okay, and then others you can check in your textbook. Okay, but I want to go back here, section 33(1). So section 33(1), it says that whatever expenses that is incurred wholly and exclusively. So that is the keyword. Expenses or outgoings. In that section 33, it says that whatever expenses or outgoings that is wholly and exclusively to generate the income, then it is allowed. So the keywords here, outgoing and expenses, the definition is that outgoing is much broader, where expenses is more specific, like interest expense, rent expense, repairs, and others, as well as interest payable. Okay, interest payable, although it is not paid, but is considered as expenses for that year. Outgoing is much more broader, such as losses due to theft, defalcation by employees, bad debts, specific bad debts lah. Okay, so outgoing is not the specific expenses which is normally recognized in the income statement. Alright, so this one I have explained to you. Special deduction. So special deduction is not mentioned in the act, but it is given by way of like gazette orders. Okay, for example, because government would like to encourage certain things, so they give this as a deduction. Okay, but this one example I put here is not the government encourage, but government would like make it compulsory the company to do this, therefore they will provide the deduction, special deduction, which are example here, the statutory audit fees and the secretarial and tax filing fees. These are items that the government request the companies to do, therefore they allow as deduction, which certain not all the cost is allowed, but they put certain maximum cost that the company can deduct. Okay, for the details you can check the textbook as well as for other examples. Next, double deduction or further deduction. Okay, so double deduction is like this one is also given by way of probably in the Income Tax Act, but it also can provide according to the gazette orders or incentives through budget, something like that. Okay, so double deduction such as salaries for disabled person. Okay, for example, if the annual salary is 12,000, but the company may deduct 24,000, that is double deduction. Further deduction is like incentive, for example, under R&D. It can be double or it can be limited to certain amount. That is why they call it further. So sometimes it is not double. It can be like certain amount up to 5,000 only, let's say. So if the expenses is 3,000, double 6,000, right? But if the incentive up to 5,000 only, so they can deduct up to that amount only. Okay. So you can check also the textbook for more info on double deduction. So you need to find also info related to YA 2021 for this item. Okay. Non-allowable deduction, example, capital expenses, expenses not incurred, expenses related to investment income. So expenses related to investment income such as rental income. So you need to exclude from the expenses to arrive at adjusted income first, and then you deduct under the rental income lah. Okay, and then other income that is not allowed, for example, the contribution to EPF, which is more than 19%. So we need to add back for the portion which is more than 19%. And another section that you need to remember is section 39 of the Income Tax Act. So section 39 specifically prohibited the expenses which is private and domestic and not wholly and exclusively to generate the business income, except whatever specified under section 34 and gazette orders lah. Okay. Okay, what are the tax rates for companies tax? For YA 2021, the tax rate we can divide into two types of company, which number one is the SME and number two is the large company. So the definition of SME is those company with paid up capital less than 2.5 million. So this is the definition by the income tax, okay? If the company's paid up capital is less than or equal to 2.5 million, they can apply 17% tax rate on the first 500,000 of their chargeable income, CI chargeable income. If they have the chargeable income more than 500,000, the remaining chargeable income will be taxed at 24%. And then for large company, which defined as paid up capital more than 2.5 million, so their income or the chargeable income will be taxed all at 24%. Okay, now this is the format to translate, to translate from profit before tax in the income statement to business adjusted income as in taxation. So what we need to do, this one is in the case of one business only. What we need to do, okay, profit before tax, normally we have added income from our sales, our main core business, or we probably also add income from other type of activities such as rental, dividend, and interest. Okay, we also have allowable expenses, expenses that we may be allowed in taxation, as well as non-allowable expenses in taxation such as depreciation and expenses initial, domestic, and so on. Therefore, we need to adjust those by from the profit before tax, we will minus other source of income, which means that now our target is only business, section 4A. So we will deduct other source of income such as rental, dividend, and so on first, and we will add back later under other section here in this 1, 2, 3, 4, 5. Okay, so first we need to deduct other sources of income. We will deduct non-allowable income, non-taxable income as well. We will deduct, for example, sales of the fixed asset where we receive gain. So the gain is not taxable under income tax. We remove, and then double deduction expenses. Yeah, okay, meaning that for example, salaries for in the income tax, in the financial statement, we have deducted 12,000, for example. Therefore, we can deduct another 12,000 to arrive at the adjusted business income for double deduction item. And then expenses not included in the profit before tax. For example, expenses that we have incurred but probably for future years. So it is like in FA, probably it is not the current year expenses yet, right? But in taxation, we can recognize as expenses already. So we can deduct those expenses which is not included to arrive at the profit before tax. Next, we need to add income not captured in the profit before tax. For example, if you sell something probably in the future, okay, but you have received the cash, so it can be regarded as sales in taxation, which is taxable. And another example is the withdrawal of stocks. So withdrawal of stocks in accounting, probably you just record as withdrawals at cost. However, in taxation, you need to record as at market value, so it is income. And next is non-allowable expenditure, capital expenditure, initial expenditure, personal expenditure, which has been deducted to arrive at the profit before tax. Therefore, in income tax, you need to add back those not allowable expenses to the profit before tax. Okay, and also expenses related to other source, which has been deducted, we need to add back as well, and then we will deduct later under other sections, section for C or D. Okay. Then when we arrive at business adjusted income, we will calculate to arrive at business statutory income by taking account all the capital allowances or industrial building allowances, balancing allowance, and add the balancing charge. So business statutory income, actually we can deduct the previous year's loss or loss brought forward. However, actually, there is a maximum number of years, only up to 7 years. Yeah, we can carry forward the previous year's loss up to 7 years only, actually, to arrive at the net business statutory income. Okay, after we finish doing this one is for section 4 small a, then only we will add. Okay, so we have arrived at this stage 1, the business statutory. We will add other income, statutory income. Okay, let's say section 4C, interest income, dividend income, and then for D, rental income, and for E, for F, other income. Okay, so we add all together the adjusted income, which is also the statutory income, to arrive at total or aggregate income. So in company taxation, we don't have personal relief, so we will get directly the aggregate income. After we get the aggregate income, we will deduct current year business loss. Okay, let's say here actually profit before tax is okay, but when we calculate the adjusted income, we get loss. Okay, so the loss will make the adjusted income 0. So the loss will be deducted here, the current year loss. Okay, we need to deduct the current year loss first, and then only we can deduct the approved donations, if any. Okay, so if we have extra aggregate income after we deduct the current year business loss, we can deduct approved donations up to 10% of aggregate income. If the approved donation is more than 10%, therefore it is regarded. Okay, so you just take up to 10% of AI or aggregate income only. Same as zakat. Zakat is deductible here after we deduct the current year loss, but zakat is limited to 2.5% of aggregate income only. If the company pays zakat higher amount, then it is regarded as well. Okay, as well as other deductions that we can be deducted after aggregate income, like pre-operational expenses, and the rest you can check your textbook. Okay, after that we can get the chargeable income as the basis to calculate the tax liability, where we will time the tax rate of 24% or 70%, like I explained just now. And finally, we get the tax liability to be compared with the amount of the tax has been paid using the estimated amount. Okay. So with that, thank you for listening. What you think, you become. Your thoughts create you. What you do, you are. Your actions define you. So these are the picture which reminds me of our days where we can have face-to-face class previously, and I really hope that we can meet face-to-face sometime in this year. Okay, thank you.